We're winding down this first full week of December, and as things stand heading into today's always anticipated U.S. jobs report, a U.S. dollar that has mostly been under pressure in 2017 is enjoying a nice week of gains pretty much across the board. The pound is the one currency that has managed to outpace the buck, with the relative strength coming from optimism surrounding progress on Brexit negotiations. The question right now is, how will the dollar close out the week, and will it once again run into another intense round of selling as medium and longer term players look to build into their existing U.S. dollar short exposure? The U.S. jobs report is always a good place to look for activity, and there very well could be another dollar run later today if various components within the report ramp up above forecast. As has been the case for many months now, the NFP print and unemployment rate are much less relevant given the fact that both of these readings have recovered to levels that would justify a more aggressive Fed policy normalization. The component that has, however, given the Fed big headache is the hourly earnings component, which has yet to really show any signs of pickup. And if hourly earnings remain subdued, it reflects a labor market that may not be as so robust as the other components would have us believe. And so, once again, look to the hourly earnings for insight into the U.S. dollar's fate to close out the week. If hourly earnings come in above forecast, expect the U.S. dollar to accelerate gains. If, on the other hand, hourly earnings come in soft, the dollar could quickly reverse course back the other way. As far as the actual data breakdown goes, this report will perhaps be a little more interesting to watch, with economists believing most of the hurricane impact to have been washed away, which means today's results should be a more accurate reflection of how things really are out there. On the NFP front, the market will be looking for a print of 195K versus 265K previous. The unemployment rate is expected to hold steady at its lowest level in 17 years after reaching this milestone of 4.1% in October. And as for those average hourly earnings we've talked about, the market will be looking for earnings to tick up to 0.3% month over month from 0% previous and 2.7% year over year from 2.4% previous. That's all for now.